All right, Steve, we're
Jump
here
in.
in the post game here and after the show, and just continuing on from where we left off. What I wanted to first of all just thank you for coming on to the show because I think it was back in 2015 where I had the opportunity to meet you for the first time. You came up to Canada from you're out in Connecticut, right?
Yep.
Yeah, and so
Greenwich,
you came up to Canada, and we went and did a little tour with the Montreal Exchange promoting Canadian options, and so I had a chance to meet, and we chatted along the way. Unfortunately, for our listeners that were hoping to get some insights from you from a market making perspective, we apologize that you're not going to get anything from Steve. There's a logistical issue that we'll cross that bridge and get Steve back on afterwards, but we're not going to dive into that. But anyway, Steve, you wanted to throw a couple cheap shots at the Toronto Maple Leafs. What's going on here?
Well, here's the thing. I mean, I grew up on Long Island, and I'm a proud fan of the lone team that plays there. And I would like, and I was thinking, because last night as I was watching the hockey game that some of you may have kept an eye on, that there's a real lesson in here that if you assemble a great group, you can actually, as long as you're well managed and as long as you have a really good game plan, you can withstand the loss of whoever the most important person is to your team, and sometimes actually do quite a bit better. And and it doesn't even matter what kind of pajamas they wear. And that this way, I do have to apologize, by the way, for the folks who do live. That was a bit much.
No, it wasn't. It's great. First of all, Kevin is a Winnipegger, so he's a Winnipeg Jets fan, and so he enjoys watching you trash talk the Leafs. But you know what? I for one, I have to agree. I'm not going to disagree because it is a team game. You look at Edmonton Oilers and they can have McDavid there, and it doesn't matter. It's one player doesn't make a team. You need the whole package, right?
I'm just amazed right now, and I've suffered with this team for a while, and you guys and you
we suffered with the Leafs
for a long. Yeah. You've suffered with the Leafs for a long time too, and the fact that you guys let Lou Lamoriello go, and the fact that the Capitals let Barry Trotz go, and that we managed to get both of them, and and literally you really did take the same team. Effectively, we swapped out John Tavares for Leo Komarov, and Leo Komarov and a system, and look what happened.
Yeah.
And it's just so I don't. It's the first time I've had a chance to gloat on a hockey sense for I don't know since the '80s. So,
yeah.
So I just had to
you know
do it,
what?
especially last night. What?
I would love nothing more than the Leafs and Islanders to meet in the playoffs at some point. That I think would be pretty epic.
It was, I was half waiting for Darcy Tucker to come out and give someone a knee-to-knee hit last night.
All right. Anyway, Steve.
But I have a feeling it'll get very chippy.
All right, Steve. Was there anything on your mind that you still wanted to share with us? Like, what's your thinking on? Do you have any views on like the currencies or bonds or anything else on the bigger picture that you sort of wanted to kind of get on record?
Well, I think we touched upon the two things, that I want on the bond side that I thought were most important, which was, the composition of credit type of thing. By the way, while I did the old anecdotes, I remember one of the first things that one of the first big research reports that I remember, like when I was on the street. This was Salomon Brothers, like 1987, as I was in the training class. I wasn't in the Liar's Poker's training classes. I was the next year. But, and that was that Henry Kaufman wrote this big report. He was, Dr. Doom, I think was his title. It was his nickname, about the I forget what it was, like the decomposition of credit or something. And at that point, it was how we were just a steady decline of AAAs, and that the bond market was at risk because the AAAs were disappearing, and we were getting more into and that the investment grade was being dominated by single A and double A. And here we are having the same conversation all these years later, and it's like triple B
Wow.
and hanging on to the edge of the precipice. So that's been sort of a one-way street, for 30 years. So while I think I think it's more meaningful now because no one wants to fall off that cliff from investment grade to junk. But that's been a concern. That's been a backdrop concern. Credit has been moving in one direction and one direction only, and that's sort of worse. The balance sheet worsening over time. People have just gotten so much more inured to leverage on a balance sheet.
Yeah.
That's out there, and the negative interest rates until or unless Europe can actually maintain a positive interest rate, a non-zero interest rate in the biggest economies, it's hard to make a case for the world economy zooming ahead.
Okay, can I interrupt here? So it's Kevin speaking. I have two questions for you. First of all, I didn't realize you were on the Salomon Brothers kind of training class. And the first question I have is, was the guy that came out and talked about the fuck face or whatever, he's like getting your face fucking ripped off from the Michael Lewis novel, was he in? Did he speak to you guys?
Yep.
Yes.
Oh, no. I know. I all those people that he mentioned, I pretty much knew who he was talking about because they were.
Oh, that's awesome.
So when he came out and said you're gonna get your fucking face ripped off and all that stuff, that was like for sure he came to the kind of training kind of class and said those things.
Yeah, what happened was you would go through the class. You came in. I actually came in off semester. I got hired. It's a long story, but I got my MBA right on top of my bachelor's degree. And so this was a raging bull market. So I was able to push them back 6 months. So at this point, they were running 2 training classes a year. So I was January '87. I was supposed to be July of '86. But I pushed them back and put a backpack on and went around the world for a while. That's how I ended up in the foreign equity area. But basically what you would do is it was in many ways like a college setting. You had your little class and your little group, and you had this room, and it was a training room, and different people from around the firm would come in and tell you what you would do. And of course, there was also like, you'd kind of get your Series 7 and your Series 3 and some of these other things, get your licenses as well. But they would come in and talk about what they did. And in some ways they were selling their area of the firm because they wanted the best, as the firm was growing, they wanted to be able to get the best crop of people from the training class. So then you would do these rotations and you go around, and there were certain guys who went through that group, and you're just like, oh crap, I don't want to be anywhere near this guy.
Dallas and equities in Dallas, right?
Equities in Dallas. Now I will say, as someone who did choose equities, I actually, everybody thought I was going to government bonds, and the reason I didn't do it was I got a weird vibe from the guy who I would have been working for. He ended up getting indicted a few years later because of the Salomon Brothers Treasury bonds.
He was the fixing guy, the guy that fixed that submitted bids illegally.
Yep.
Ah.
Yep. So I dodged that one. I would have been a government bond trader working for him, having either. So I'm glad that was a good miss. So I ended up going down. I like equities. It was more rough and tumble, and that's the one thing Liar's Poker gets wrong. Is it's very because he wasn't on the equity floor, his stuff about the crash was very superficial. It's a lot of guys screaming and yelling at each other. Yeah, of course it was, but you missed a lot of stuff, and we could do a whole hour on what happened, on those 2 days. But essentially, that was the short version is the system locked up. There was a coordinated effort among all the firms, of which Salomon was one of them, with the Fed backstopping everybody. And because everybody remembers Black Monday, but Black Tuesday was worse because at that point the whole system had locked up. And it basically took a major intervention. All the firms basically. I want all you fuckers to call down the floor and find out what the fuck it would take you to open up any of these stocks that you fucking trade that are not open yet. Cigar-filled room, and that's the real story. And I just don't have the time to do that one justice.
One of the issues,
that's the story, and Michael Lewis didn't get it.
Right. One of the issues with that was not the fact that the futures, which were a lot of the ARB guys, and I remember reading this somewhere, was the fact that like if you were sitting there on the Salomon Brothers, I believe you guys were one of the biggest index ARB guys at the time. If you were sitting there and you were buying futures at a discount and selling stocks, you had a mark to market on your futures, which were collapsing, that you were actually having to come up with the margin that day or like later that day. And meanwhile, the stocks, and which back then they had a 5-day settlement. So you weren't actually getting the money that you needed to actually, submit it to the from the New York Stock Exchange to the CB. I guess it was the CME at the time, the Chicago Merc, and there was a mismatch in terms of these futures products. And I remember reading books where they said that they had stopped guys from doing the index ARB because of this problem, and there was a whole bunch of firms that were threatening to go under, and the Fed had to force the banks to kind of lend the money unsecured, to fix this mismatch in terms of timing. Was that kind
basically that? That's basically true. I mean, they joke about the plunge protection team, but that really was the plunge protection team, and that was really the biggest example. But what happened was, we got in that Tuesday morning, and the morning meeting was essentially the specialist system is bankrupt. So you can't rely on these guys to make markets. And that's what happened, because you woke up Tuesday, and first of all, there was the portfolio insurance idea. So that was that you could always re-hedge your portfolio by selling futures, which is great, except anybody, when you really think it through, that just always assumes that there's a bid in the futures. But if everybody's trying to do the same trade at the same time, there was no reasonable bid at the futures. That's why they were at such a discount. And what you then had was, the specialist firms who had been, buying on the, forced to make a two-sided market. These were small, somewhat poorly capitalized firms. So these guys really were sort of technically bankrupt. So when the selling came back on Tuesday, I think they were hoping to sell out of some of this stuff. Some of the stuff they went home long on Monday, but they were just out of it. So literally there were no bids, and literally most stocks were offered only. There was no bid because there was no one to step in. What happened was, so the Fed, and this is, I wasn't in the room. I was, my job at that point was literally moving the NASDAQ markets and not picking up the phone, so that we would not be on the bid in any of the stocks that we had a NASDAQ responsibility. I remember I wore both hats from a very early point. As trading OTC and listed, and basically as the junior guy on the desk was just me and one of the other junior guys just moving the prices. If we're on the bid, get it down, and if the phone rang, don't pick it up and figure out what you're on the bid on so you can get down, so you didn't have to trade. That's really what I spent literally 2 days doing. But what happened was, at that point, you could just see that the game around noon, it was it. There was nothing. There was literally nothing going on because there was nothing trading. There were, all these stocks had, were to the sell side. There were no bids. The futures had basically locked up because you couldn't do the ARB anymore because of the timing mismatch, and because there is no ARB, because if you can't sell the stock, what's really the price? There is no ARB, and so. I don't know, the big smoke-filled room. This was a time people still smoked cigars, and you could always smell John Goodfriend coming because his cigar. You have the smell of the cigar ahead of him, and so they all get in a room. And I remember hearing things like Stanley was Stanley Shockwave, Stanley Mnuchin, which that was Father Mnuchin, not the president, the father of the Treasury Secretary, who was basically the equivalent guy at Goldman Sachs. And from what I gathered. Basically, it was some conference call with like the Fed and Goldman and Morgan and a few of the bigger trading firms, and that's when he came out and said, "I want all you guys to find out what it would take to clear any imbalances." Now, think of the psychology of this. the market's frozen, and then the Salomon Brothers brokers asked this question at the same time as the Goldman Sachs brokers, at the same time as the Morgan Stanley brokers. I'm not sure who else was in this, group. Lehman Brothers probably, some others. All of a sudden, the guys on the floor, they're not stupid. It had as much of a psychological effect. So we didn't actually buy as much as you'd think, because the mere fact that it was obvious that all these firms ran into the crowds at the same time to try to clear the imbalances, in effect cleared the imbalances for them. Cancel that sell order.
It's like J.P. Morgan in
1907
or whatever it was.
Same basic strategy, yeah. But that was J.P. Morgan as a person. In this case, the part of J.P. Morgan was played in that production by Alan Greenspan.
Right. Okay.
But largely, yeah.
Wow.
So there you've got some good anecdotes out of me. Damn it. I don't know what I'm going to bring next time you have me on.
I'm pretty sure you're going to figure something out. There's a lot more I'm sure that we can get into. So my second part of it was, okay, so we were talking about that, and I'm just trying to remember what you had said in terms of I had 2 points that I wanted to ask you in terms of the markets, but now I've completely forgotten. Patrick, why don't you just take it away? Because you know what, I'm kind of 2 beers into this, and I'm actually enjoying our beers. So why don't you
know
go,
what?
Patrick?
I'm dying to step away here to go grab another pint. I'm like too
you
far away from the fridge.
Patrick, you have to understand. You got to put them all beside you so that you can do it Tony Greer style.
Yeah,
and just kind of keep popping
just
them.
keep the
like, as they come
6-pack right beside me here, so I can just keep them cracking. Right, like the fool in me is like, I'm gonna keep them cold in the fridge, but I'm realizing that I'm stuck to this microphone. But
okay, so Steve,
I'm several behind.
Yeah, that's right. You're gonna have to get out to the bar right away.
So I can't drink on the desk, so I gotta catch up later.
That's right. So Steve, here I have a question for you. Do you think, I see that I think Dudley came out today, one of the Fed board, the FOMC kind of board members, and he started talking about threatening to raise rates in the second half of 2019. And so far, this is the first thing we've heard in terms of a Fed kind of getting cold feet, a Fed member getting cold feet and trying to tamp down kind of expectations. Do you think this is the start of something more that we're going to see?
I think he just I took that to mean that he didn't really want to. I think what he's getting concerned about is, I'm a big consumer of the WIRP page on Bloomberg, the WARP, as
right.
you are. And that's got the rate hike probabilities, and I pulled it up now as we're talking. You've got a 7% probability out to the end of the year, and actually it declines as you get into 2020, about 6%. And so I think this is his way of saying, hey, back up here a little bit. We're not, just because we talked an accommodative game doesn't mean we're necessarily going to accommodate. And I think those of you who, we went from the likelihood of 2 rate hikes to essentially 0 in a very short period of time, and now you have people starting to talk about rate cuts in 2020. I think these guys really are trying to just keep a little balance here. I think it's just not.
Yeah. So if you look,
I don't want to read too much into it.
But if you go look at the Eurodollar, I look at the March 9, 2019 versus March 2020 spread,
here,
and
I'll pull it up.
That's basically the amount of easing or hiking that we could expect, coming from March 2019 to 2020. Now, this is the Eurodollar, so obviously it's not perfect versus Fed funds, because you do have that kind of LIBOR versus Fed funds risk, but it's kind of indicative of what the market expects. And we'd reached a point where just 2 days ago it was trading minus 10 basis points, and today we kind of poked our head above 2 basis points. So for the first time, it's gone from them expecting a cut, or at least somewhat of a cut, or the probability of a cut, to now going the other way. So
It's still
I'm not
hovering
sh-
zero though, Kev, because
Yeah, no,
if
no,
you,
I get it.
if you
Like,
go to 2020, when you go December 2019, December 2020, we're still negative 14 basis points. So there's still the likelihood of a cut next year is still there. It's really the likelihood that this year there's a cut is pretty much.
But you
close
know
to
what,
zero.
Patrick, I find most amazing is like go pull up like December 2019 Eurodollar futures. Just let's look at that chart. Just like straight
sure.
out, December
Yeah, right here.
2019
There you go.
futures. So as we've rallied and we've had this rip-roaring, risk-on rally, it's been shocking to me that until today, or until the last 2 days really, this has been trending higher, meaning that they've expected kind of lower rates. And it's been usually when you get a rip-roaring kind of risk rally, they at very least keep, like let's say interest rate expectations flat. They're not pricing in increasing chances of kind of an ease. And what worries me is when I look at that, it kind of this leads further credence to the argument that we've been kind of the short squeeze thesis might be correct in that we've kind of been squeezed up by the Fed, going dovish or at the very least going less hawkish, and it's forced everyone kind of into risk assets. And the reality is that the Fed's not that comfortable with it, and as risk assets rally, eventually we're going to see a reaction function out of the Fed, and they're going to at the very least say, hey, whoa, we're not going to ease, and if anything, we're going to raise. And that's what I worry about. I don't know if the market's ready for that.
It's not. That would be ugly. But then again, we're talking about we've had a whole discussion about how the economy is going to be tepid at best. I think you get into stasis, but I do think they want to balance the risks. I think that's crucial to them, and I think the market's kind of lost that sense.
Well, Steve, listen, it was so great having you on the show. Thank you so much for giving us your time, and I think that it was great. Any closing words there, Kev?
No, I just want to thank Steve. Like that was, I'm still laughing at the calling in fat. Like that was one of the greatest stories I've heard in a long, long time. So I really appreciate you coming, Steve. It was a pleasure meeting you, and we look forward to having you on again.
I'm looking forward to it already.
All right.
Take care.
Thanks a lot. All right. Cheers.